All right. Hello, everyone. This is section 8.2, which is income tax. And here is a famous quote from Benjamin Franklin. I'm sure you've seen quoted in movies and so on. In this world, nothing can be said to be certain except death and taxes. Does not put a positive spin on taxes, and nobody loves to pay taxes, but it's just part of our society and culture and responsibility and all those things in the U.S. certainly. And so we're going to talk about income taxes in this section. So let's get into that. We talked, at least in face-to-face classes or meetings, about the national debt and the concept of million, billion, and trillion. And so the government, our U.S. government, goes through a lot of money. We now owe other countries and other banks and so on over $20 trillion, and trillion is a huge number. And so in order for the government to spend that kind of money, it needs to get that kind of money from somewhere, even though we're in debt. And so most of this is collected by way of taxes and fees and whatever they call it. They're all just taxes. And so one of those forms of taxes is income tax. And it is based on a percentage of your income. And so in determining your taxable income, we're going to go through some of the steps on a basic Form 1040, it's called, doing your income taxes, typically at the end of the year, sometime before April 15th. And so the first definition that we have here is your gross income. Your gross income is calculated and put on the very top line of the form here, line 7. Well, it's not the very top of the form, I guess. Above this is your name and that kind of information, how many people are in your household, so on. But the first line of the income part of the 1040 is gross income, and it is calculated by adding up your wages, salaries, tips, so on. Anything that is provided to you on a W-2 form, required by U.S. law from your employer to provide you with a W-2 form. So yes, if you're a waiter or a waitress or whatever and you get tips for different things, then you're supposed to report that as well. Anything that is considered a salary or wage. Okay. And then we go through and add up all these other topics in here. And so it might be dividends that you earn on investments. It could be a business income. It could be alimony received. Line number 10 there, taxable refunds. So your California state taxes, if you got a refund last year, you're supposed to claim it here and put it in there to where you pay income tax on it. All these different things, farm income, unemployment compensation is taxable, all those different kinds of things. And so you put all these that apply to you in, and then at the very bottom you add them all up, and that is your total income. Okay, also referred to as your gross income. Okay. Then we want to be able to determine your adjusted gross income. And this is probably the most important line on your Form 1040 or on your income tax form, because this is used for lots of things. Used for financial aid for college. It's used for when you apply for like a mortgage and those different kinds of things. It's your adjusted gross income that they're interested in. And so the adjusted gross income is taken from that line above, line 22 that was on the last slide. And then you are allowed to take off some deductions. They're actually called adjustments. So that's how we get to adjusted gross income. So these adjustments go from educator expenses. And so if you and or your spouse are educators, then you can take off to a maximum right now, and this changes from year to year, $250 each. And that's things that they just kind of know that you buy for your classroom that the school doesn't provide. But there's all these other different things, health savings account deductions, self-employment if you are self-employed or your spouse is self-employed, alimony paid, IRA deduction, student loan interest deduction, supposedly that's going to go away, tuition and fees, all these different things you can basically reduce your income by, and then therefore reducing your taxes. And so if you have any of these, you put them on each line and then you add them all up and put that on line 36. And then notice the line 37, it says subtract that from your income up above on line 22. So if you subtract all these expenses and and adjustments, then this is your adjusted gross income, or AGI. Line 37, it's the last line on the front of a 1040, and you transfer it, you flip it over, and you transfer it to line 38 on the back of the form. And this is the most important number that you need for lots of other things. Okay? So, determining taxable income now. We're going to take that adjusted gross income, your AGI, okay? We're trying to figure that out, and the way you figure that out, again, from the last slide, is you take your gross income and you subtract the adjustments, okay? Once we get that, then again, we put it on the next line, 38, and then you go through the rest of the form. And exemptions are also money that you can essentially take off or reduce your income by to get down to your, we're still trying to get to your taxable income here. And so exemptions are basically what the government says it's going to take you to live for each person in your household. And so on the front of the form, you said how many, maybe you and your spouse, and you have 2 kids, say. And so you have 4 deductions, or 4 dependents, sorry, on your taxes. And so you take that number from the front of the form. In this particular case, this was 2016, each person gives you a $4,050 exemption, it's called. And so you would go 4 times 4,050, so what would that be? $16,200 would go in this, and you would reduce your income by $16,200. You don't have to pay taxes on that $16,200. This is awesome, it's great. Okay, so those are called exemptions. Okay, a tax credit is way better. Tax credit actually reduces the amount of taxes you owe to the government. This one before, an exemption and the adjustments that you made earlier, all they do is reduce your income. And so if you take $1,000 off your income for taxes, that's good, but you still have to pay a percent of what's left. Whereas a tax credit, after you calculate, say you owe whatever, $10,000 in taxes, a tax credit for like child tax credit, those kinds of things, reduces how much you owe the government directly, reduces that $10,000 by every tax credit you can get. Tax credits are great. You need to find as many tax credits as you can. Okay, tax deduction reduces taxable income as well, and so they're kind of broken up in a couple categories on the forms here, so let's look at that. So itemized deductions are still going to affect your income, and so there's a separate schedule called a Schedule A in the tax preparation forms. And if you would need to have like a mortgage, is kind of the biggest one to be able to itemize. You're giving, you're tithing to your church or other charitable organizations. Other taxes that you pay, like sales tax, car registrations, property taxes on your, again, if you own your house or property or whatever. And then there's other things like medical expenses and job moving expenses, some of those things, but they're definitely reduced in the way that you can deduct those. But things like mortgage, charitable contributions, and other taxes that you pay, those are typically the big ones for most people. And so you would go through that Schedule A and write those things out and add those up and calculate the total of that. And then if you don't have those things, a mortgage and contributions, all that kind of stuff, then the government says there's a standard deduction that you can take per person in your household. And so, the standard deduction is for your household if you are filing jointly or filing singly. And that the standard deduction changes every year. So it's a different amount. I can't remember what it was in 16 because I don't take it because I do have a mortgage and so on. And so I do the itemized, but I think it was somewhere around, I want to say $6,000 or something like that. And so if your itemized deductions add up to be more than that $6,000 or whatever it is for the standard deduction, then of course you want to take your itemized deductions. But if you itemized deductions don't add up to that much, then you get to take the standard deduction and reduce your income by that much at least. And so kind of hard to explain the difference between exemptions that we had before, where the government says that's how much it costs to live, and standard deduction. And so this is part of what makes our tax code so complicated, and they're trying to fix. So a standard deduction is a lump sum amount that is subtracted from your adjusted gross income to, again, reduce your income. Okay. An itemized deduction goes on that Schedule A. And so again, it's things like mortgage interest and taxes paid, sales tax, car registration fees, those kinds of things. And so I've kind of already explained these definitions. And so here's an example from your book. This is like one of your homework questions. And this one's a little bit complicated here, but this is the way the questions are. And so it says a single man earned wages of $46,500. He received $1,850 in interest from a savings account. That would be a large savings account. Received $15,000 in winnings on a television game show, and contributed $2,300 on a tax-deferred savings plan. He is entitled to a personal exemption of $3,800 and a standard deduction of $5,950. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes, $1,855 in state taxes, and he contributed $3,000 to charity. So all that's kind of complicated. We're going to break it down in steps here. So determine the man's gross income. Well, gross income, again, is all of your income. And so we'll take his wages of $46,500, the $1,850 that he received in interest on a savings account, and that $15,000 in winnings. Okay, so let's do the A part first. So he made $46,500 just in his job or whatever, $1,850 in interest, and the $15,000 in winnings. So we're going to add all that up. So his gross income would be $63,350. It's all the money that he made. Add it all up. Okay, so that's the answer to A. B, determine the man's adjusted gross income. Well, to get to the adjusted gross income, you need to take out some of the other things that he contributed to and so on. Okay, so let's answer part B here. So we take that income, we just calculated, $63,350, and we subtract that $2,300 that he contributed to a tax-deferred savings plan, so like an IRA or something like that, a 401k or 403b or something. Okay, so we reduce his income by that much. And so now his adjusted gross income is $61,050. So that $2,300, he doesn't have to pay taxes on that $2,300. We reduce his income. Okay, now we're going to determine the man's taxable income, and this is kind of a two-step process here. So let's jump to part C, and I should have put this question on the next slide, but I didn't do that. So we're going to need some of these numbers, but basically what affects letter C here is he's entitled to a personal exemption of $3,800, so we're going to take that out. Standard deduction of $5,950, take that out. And then because he has home mortgage of interest of $6,500, $2,100 in property taxes, and $1,855 in state taxes, as well as a $3,000 to charity. Sorry, I need to back up. The standard deduction of $5,950 is what we're trying to compare this to. Okay, so that his interest $6,500, his $2,100 in property taxes, his $1,855 in state taxes, and $3,000 to charity. Those things are all going to add up to be more than that $5,950, and so we want to itemize for him. So let's look at this. So determine which would be more beneficial, his standard deduction or his itemized deduction. Again, the standard deduction is $5,950. Well, just his home mortgage deduction alone, the interest he paid is more than that. So we know we're going to itemize here. We add the $2,100 and we add the $1,855 and the $3,000 to charity. So all that added up is going to reduce his income. Okay. If we didn't have those things, then we would just take the $5,950 that the government says you can take. Okay, but we add all these up, we get $13,455. So considerably better than the standard. So that's what we're going to use. So you choose one of these, whichever one is better, more beneficial to you. Okay, so we choose the itemized deduction. So his taxable income, remember, was $61,050, the answer we got to part B. And then we subtract the $3,800 because that was the exemption that he got, okay, because he's single. If he had more people in his family, so he'd get more than that. But and then this $13,455 itemized deduction that he added up to. So we're going to subtract both of those things basically, or add those up and then subtract it, however you want to think about it. And so his total income now is $43,795. That's his taxable income. That's what he would go to the tables in the tax forms and go look up how much tax he has to pay on that. Okay. All right. When you do go do the tax tables in the paper thing that gets sent, well, I don't know if it gets sent to you anymore. Even they're so cheap you have to go get it at the library or post office or whatever. But this table shows how it is. So people talk about, well, I'm in a 25% tax bracket or I'm in a 15% tax bracket. Well, technically nobody's in any one of those brackets. They all kind of apply. And so this is how our tax code works currently. And so the tax rate, or at least this is how it works when your book was written and all those kinds of things. The tax rate for the first $8,700 that you earn is taxed, well, depending, single or married filing separately, or the first $17,400 if you're filing jointly, or if you're filing head of household, it's $12,400. So depending on how you file, that's where these tax rates come in. But I'm just going to run with the single one because that's the example we're working with this guy that we just did those other calculations with. So up to $8,700, you only pay 10% tax on that. Okay. The amount you make from $8,701 to $35,350, and I don't know where they come up with these numbers, but you pay 15% of that bracket. Okay. Any money you make over $35,350 and the first $8,700, then you start paying 25% in that range, 35 to 85. If you even have more than that, then you start paying 28%. If you have more than that, you start paying 33%, and so on the remaining portion. Okay? So let's do an example. Let's continue with him, in fact. So our single man with a taxable income of $43,795. Well, we're going to look at the first $8,700 from the table. So the first $8,700 right there, we have to pay 10% of that. So that's $870. So first chunk that he has to pay is $870. Okay? And then we reduce his income by the $8,700 because we have to find out how much more he made beyond that. So the $43,795 minus the $8,700 gives us now $35,095, which actually fits directly in that next range, the 15% range. If he had made more than that, then we would just take the $35,350 part and multiply it by 15, subtract again, and keep going. But this is going to finish it for us. So the $35,095, that fits in the next category. So we multiply that by 15%, and that gives us $5,264.25. That's how much taxes he has to pay on just the $35,000 part. We take it and add the $870 that he had to pay on the first $8,700 he made and get the total. So he has to pay $6,134.25 in taxes. Sorry, these numbers always kind of boggle my mind. He made $43,000 essentially to live on after all the other things that he had to take care of, and now he has to pay $6,000 of it, 1/7 of it, to the government in taxes. Okay. Now, hopefully he was having that withheld from his check all along, and that's where we get into the concept of do you have to pay at the end, or are you going to get a refund if you paid too much already? Then you get a refund of that. If he'd already paid $8,000 in from withholding from his paychecks, then he's going to get a refund. But then you're just giving money to the government to hold on to you instead of you being able to use it to live on each month. And so you want to try to make this to where the amount that you owe at the end compared to what's been withheld from your check every month, those totals come out to essentially zero apart from each other. You don't owe them anything and they don't owe you anything. You were getting everything you needed to live on or save or whatever instead of letting them collect interest on it and so on. Okay. All right. Social Security and Medicare, we all know that we pay these out of every paycheck that we get and so on. And again, it's a semi-complicated percentage calculation here. So we're going back to Section 1 and our percents and so on. But we're also required to pay FICA taxes, Federal Insurance Contributions Act, towards Social Security and Medicare benefits. Okay. FICA taxes are paid on gross income from wages only. So this has nothing to do with the whole adjusted gross income or taxable income. It's just on your gross. That's just it. Okay. And so we're going to look at this first table or first column over here where you as an employee pay 5.65% on the first $110,000 you make. After that, it goes down considerably to 1.45. Okay. And if you happen to be self-employed, you get hammered here because you have to pay your part as the employee and you have to pay the company's part as the employer to the government, so that all that money goes into Social Security fund, so that when you're ready to retire or whatever age you choose to take it, that those funds are in there and so on. Okay, hopefully. So let's look at that. Let's say you're not self-employed and you earn $150,000. What are your FICA taxes? Well, the calculation here, and you have homework examples like this, or questions like this. We take the first 110,000 and multiply it by 5.65%, because that's what the table says. That's $6,215. Then you take the remaining amount, the 40,000, from 150 to 110, and multiply it by the other amount there, the 1.45% in the table. That gives you $580. So those two are the total taxes that you have to pay, the $6,215 and the $580. That adds up to $6,795. So basically $6,800 is what you end up paying in Social Security taxes throughout the year. Okay, so that's an example of a question on homework. Calculating pay. We've all been here, all done this. Typically we do this especially with our first jobs. Let's say that you work a part-time job at a local grocery store. It pays $8.50 an hour. You work 20 hours a week. It's just a part-time job for you. Your employer withholds 10% of your gross pay for federal taxes, 5.65% for FICA taxes. We just looked at that, and 3% for state taxes. So we want to calculate your pay here. So what's your weekly gross pay? Well, your gross pay is calculated by taking your hourly rate, $8.50, and multiply it by how many hours you work. That's pretty basic. So 20 hours. So we're going to go $850 times 20. So we make $170 a week in this particular job. Okay, 170. B, how much is withheld per week for federal taxes? So federal taxes is 10%. Well, that's pretty basic. 170 times 10%, $17. Okay. How much is withheld in FICA taxes? Well, basically the same calculation, except it's 5.65%. So 170 times 5.65% is $9.61. And this is all money, so we always round it to 2 decimal places. We round it to the nearest cent. Okay. And then D, you can guess it, is how much is paid in state taxes. Same calculation, just 3% instead of the 10 or 5.65. So 170 times 3% is $5.10. Okay. Therefore, based on those calculations, what is your weekly net pay? Well, your weekly net pay is the $170 that you make, subtract all the withholdings that the government takes from you, and that's your net pay. So the 170 minus the 17 minus the 961 minus the 510 gives you $138.29. That's what your check is for. You made 170, but your check is for $138.29. Okay? What percentage of your gross pay is withheld in taxes? Well, it's the 10%, the 5.65%, and the 3%, right? We take those and add them together, and that's 18.65%, but it said round to the nearest tenth, and so 18.7% is what percentage of your gross pay is withheld. All right? Hopefully those are things that you've done before with your paycheck, just to see what, maybe you didn't know the percents, but anyway, we all calculate our pay to make sure it's accurate. So, all right. So that is income taxes, and hopefully you can now go through and do the work within my math lab on income taxes.